Cost to manage manufacturing, commercial, and service organization. Chapter 1. Overview. Financial accounting. Relevant information for inversion creditors, government entities, syndicates, and directors. Objectives. Report your asset, liabilities, equity. Evaluate changes in capital comparing income with cost and expense. Cost accounting. Information that determines and classifies the cost of activities, processes, and products. Objectives. Determine sale cost and calculate profit. Determine inventory cost for a balance sheet. Facilitates decision making. Allows you to crave and apply business strategies. Managerial of administrative accounting. Information system that facilitate planning, control, and decision making. Characteristic. Encourage planning, allow you to control, evaluate managerial performance, motivate to achieve. It's allow a more dynamic process, identify and correct derivation, improves the way of decision. Financial accounting. Information from the past in the base for future plans. Quick information agility in reports. General accounting. Plan for the future and have competitive advantage. Qualitative data and necessary cost. Analyzing in decision. Comparable information according to the user's need. Chapter 2. Cost classification. Cost. They define the amount of utilization of recurse according to their capabilities. Function. Production cost, distribution of sales cost, administration cost, financial cost. Function of time. Historical cost, predetermined cost, activity of department. Bidder control and allocation of resource, direct cost, indirect cost. According to time, period cost, product cost, control in the occurrence of the cost, controllable cost, uncontrollable cost. Cost behavior. Variable cost, fixed cost, mixed of semi-variable cost. According to its importance. Relevant cost, irrelevant cost. Type of sacrifice. Out-of-pocket cost, opportunity cost. According to the increase or decrease. Differential cost, sunk cost. Chapter 3. Variable and costing and total costing. Total costs are all costs related to production, raw materials, labor, variable and fixed overhead costs. Variable costing. It divides the cost into fixed and variable taking into account. Cost of the product, distribution to production, marketing, and provision of the service. Contribution margin. Define the amount of sales to cover fixed and variable cost. It allows to control cost, determine price, marketing strategies, decision making, and managing evaluation. Variable cost advantage. Eliminate fluctuations. Facilitates the preparation of the cash budget. Bidder control of fixed costs. Profits depend on sales. Improve decision making based on contribution margin or marginal analysis. Disadvantage variable costs. It is difficult to separate variable and fixed cost. It is not accepted as an official report. As there are session sales, the information is unreliable. Difference. Variable costing takes into account fixed production cost as period cost. Includes only variable disbursement cents for inventory. Total costing distributes the cost in the profits. Contemplates the fixed and variable costs for the inventory. Profits vary for both systems if there are changes in inventories due to capitalization of cost. Chapter 4. Cost volume profit relationship. It is very important to note the relationship between production costs, production volumes, and the profits generated so that the executives can make the best decision for the director and planning of the company. Break-even point. It refers to when the economic activity of the company is equal to the total cost and expense of production. Decision-making becomes a fundamental tool. Sensitive analysis. Simulate cost variables to determine how feasible it is to make a given decision and the impact on profits. Profit planning and the cost volume and unity rate. Determine the necessary income covering production cost, profits, cost of capital, return to inventor. Safety margin. It is the difference between actual and planned sales at the break-even point. It is useful to decision making. Break-even point observation. It is as useful to planning and decision making. It analyzes fixed cost and variation, also with variable cost with the sale price, and thus have an expected value for each variable. Assumption of the relationship cost, volume, utility. Selling price does not change. Costs can be classified into variable and fixed. Revenues and costs have linear behavior. Unity variable cost is constant. Is the total fixed cost permanent? Sales and production level is constant. Thank you.